Hi and welcome to Swissquote's Daily Market Talk. It's Monday, December 9th. The week begins with a flurry of developments. Assad's regime in Syria collapsed over the weekend. Political uncertainties continue to swirl in South Korea and in France. And while the financial markets around the world are bracing for a busy week ahead because four major central banks are set to announce their latest monetary policy decisions this week, with three of them expected to deliver rate cuts. And adding to the mix, the US will be revealing its final key data point this week, the CPI update, before, the Fed's crucial decision that's due next week. So we have a lot to talk about today. Just tune in. So the weekend was charged with emotion as news broke of Bashar al-Assad's regime falling in Syria, while the week kicks off with, quite a lot of political uncertainty. Korean lawmakers there prepare another impeachment attempt against their president, who narrowly avoided a removal after briefly imposing martial law last week, remember? And France remains without a new prime minister nominee, so it's all a big unknown for France also. As such, the US dollar is better a bit this morning due to a flight to safety, while crude oil is better a bit as well due to renewed political uncertainty in the Middle East region. But the Syrian news will unlikely reverse the bearish trend in oil because, yes, the Syrian uncertainty could temporarily hit their oil exports, but the country exports less than 100,000 barrels per day right now, down from around 600,000 back in 2011. Therefore, peace or positive developments in Syria would more likely than not bring more barrels to the market and add to the global oil supply in the coming months. Even more so as the latest data from China fails to impress because inflation there came in lower than estimated by analysts, because consumer deflation in China accelerated last month, while the slower deflation in producer prices wasn't enough to conclude that the Chinese latest stimulus measures were efficient. So the latest economic data from China only boosted the expectation that the Chinese would announce more fiscal support as soon as this week when the officials meet for Central Economic Work Conference there. But obviously, given the Chinese government's unwillingness to announce a massive fiscal stimulus package, to put a number on it, the arm wrestle between the authorities, who actually speak of these big stimulus measures but fall short of naming a figure, and investors around the world who are just simply determined to hear one simple number will continue. So the CSI 300 index in China is downbeat this Monday morning on the expectation but the uncertainty to hear a big number, or at least a number. In the FX markets, the US dollar is better a bit, as I said this morning. That's probably due to a certain appetite for safety in the middle of a global political jungle. But fundamentally speaking, the Federal Reserve news were quite soothing last week, and that's obviously supportive of a softer US dollar moving forward if we filter out the geopolitical news. So released last Friday, the US official jobs data came to sit near, not at, but near the sweetest possible spot for the Federal Reserve watchers. Because the NFP printed a strong 227,000 new non-farm job additions last month in the US, but that figure was widely disregarded by the market participants due to the disruptions from the hurricanes and strikes of the month before. So all eyes were, as expected, on the unemployment rate number that came in slightly higher than the month before. Now, the US jobs data would be just perfect if the wages growth there didn't print a higher than expected number last month. But hey, you can't have it all, right? So the US dollar first fell, then rebounded on the US jobs data, while the Fed those were quite in the mood to bet on a Christmas rate cut from the Fed, another 25 base point cut, and buy more of the S&P 500 and Nasdaq stocks. So the set of figures that we saw from the US last Friday were interpreted as supporting the so-called Goldilocks scenario in the US, which would allow the US Federal Reserve to cut its interest rates without, however, pushing the US economy into recession. So the US two-year yield extended its decline, and the S&P 500 printed its 57th record high this year, meaning that the S&P 500 printed a record high level every 4 trading sessions so far this year, and well, Nasdaq 100 also closed last week at a fresh record high as well. The Dow Jones Industrial Index, on the other hand, continued to diverge negatively from its technology-heavy peers as the big technology companies outperformed their peers last week, and news that the US has gotten one step closer to ban the Chinese TikTok as early as mid-January next year should help the companies like Meta and Google also feel fresh this week, as Instagram Reels and YouTube Shorts are the closest replacement that we have in hand today for youngsters in the US who could be left with no access to TikTok overnight. Now, there is still hesitation regarding what Donald Trump would do with this TikTok issue, because he has flip-flopped quite a lot during his election campaign to either ban or not TikTok, not to push away young voters. But now that he is elected, he could easily bring the national security narrative back on the table to either ban TikTok or maybe force the company to sell it to an American owner. So if that's the case, who would buy it, right? Would Donald Trump's media company, for example, be interested? Or maybe Elon Musk, he could be interested? I don't know. But for now, well, they are not selling their company. And it is, well, quite good news for Meta and Google, who will be offering alternatives to TikTok for the young users that they have been losing for years. Now, coming back to the macroeconomic picture, the jobs data from the US is out of the way right now with a supportive narrative for the Federal Reserve. The probability of a 25 base point cut from the Fed in December shot up to 83% last week after the data, from around 70% before the data release. And this week's CPI update from the US will be the last piece of the puzzle before the Federal Reserve meets and decides next week. So, the CPI number from the US is expected to print a small uptick in November, but that's expected. So unless we see an unpleasant surprise, a big surprise on the data front, the Federal Reserve will probably go ahead and cut this month. January, however, will probably be a close call because the consensus favors a pause in the Federal Reserve rate cuts in January so that the officials there could sit down and assess the impact of Donald Trump's pro-growth policies and tariffs on inflation and on economic growth. Elsewhere, well, the week will be packed with central bank decisions, because the European Central Bank, the Bank of Canada, the Reserve Bank of Australia, and the Swiss National Bank will all be announcing their latest monetary policy verdicts throughout this week, and all, except for the Reserve Bank of Australia, are expected to lower their interest rates when they meet this week. So in numbers, the Bank of Canada is expected to cut its interest rates by 50 basis points this week, while the Swiss National Bank here and the European Central Bank beyond our borders are expected to announce a 25 basis point cut this week. But obviously, some investors are convinced that the European Central Bank could and should announce just more than a meager 25 basis point cut this week. Either the ECB could go bigger with a 50 basis point cut, or what I think is a more plausible scenario, they could simply cut by 25 basis points as expected and shift their focus from inflation that they consider being under control to economic growth that's on a slippery ground due to the economic weakness that we see on the continent, political struggles, and the international threats. But given that the European Central Bank is wildly expected to give a dovish reaction to the actual economic, political, and the geopolitical context, we may actually not see a significant further sell-off in the euro below the current levels, because a dovish messaging from the European Central Bank would, well, probably cap the euro's upside potential, but it would not push the euro down into a pit. So the single currency could be range bound in the coming weeks around the 105 psychological level against the US dollar. Now the euro dollar shortly spiked above the 106 psychological resistance last Friday, following the US jobs data. But the top sellers here rapidly came in. So the key resistance to the September to November sell-off in the euro dollar stands near the 106.72 level, which is the major 38.2% Fibonacci retracement there and should cap the upside potential, while a retreat toward the 104.50 range looks interesting for those traders that are looking for buying it up. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.